Welcome to TradeGlow FX. Trading is a field where our success rate is already very low. It might feel tough to hear this, but it's the truth. We hear everywhere that 90% of traders lose money. Some say 95%, and only 5 to 10% make profits. Since we've chosen this field, what's our job? Our job is to avoid the major mistakes that everyone makes or that we're warned about, learn from our errors, constantly improve, and focus entirely on this field. If we don't do this, will we succeed? Will we fall into the 90% who lose or the 5 to 10% who profit? If we want to be among the successful, these 6 mistakes, we've made them ourselves too, so we're not alone. Every trader does. Our real job is to understand these mistakes, identify them, and improve. So, without wasting time, let's dive into the first mistake every trader makes: ignoring higher time frames. Ignoring higher time frames means we overlook charts like the 1 hour, 4 hour, daily, or even 30-minute time frames. Most traders today ignore these, chasing quick profits. Can we make quick profits in trading? Absolutely not. If we're here to make money fast, we should quit now. Trading doesn't work that way. For quick profits, we trade on 1-minute charts, maybe glancing at the 15-minute chart. But the major levels, supports and resistances where prices respect, bounce, or get rejected, are clearer on higher time frames. The larger the time frame, the more accurate our strategy and the more prices respect those levels. On a 1-hour chart, we see trends better. On a 4-hour or daily chart, even more so. A daily resistance level is almost certain to be respected later. We must analyze higher time frames, rely on them, draw key levels, and understand the market structure, which is critical today. We hope you understood this first mistake. The second mistake many traders make is jumping between strategies. What does this mean? For example, today we trade a breakout failure. Tomorrow, a W pattern breakout on the buy side without a trap. Then the next day, we switch to a 1-minute chart for scalping. What are we doing? We're changing our strategies and trading style repeatedly. The harm? We never master any single strategy. There's a quote by Bruce Lee said it's better to perfect one move than learn 10 imperfectly. If we master one solid strategy instead of jumping between 10, we'll always get better results. Avoiding these mistakes is critical. Let's not take them lightly. The second mistake is clear. Don't jump between strategies. Master one strategy and trade consistently with it. The third mistake is trading without a stop loss or using an improper one. Trading without a stop loss is a disaster. It's gambling, risking our entire capital. A stop loss is essential. Our trades often hit the stop loss with a wick before moving in our favor because we set them wrong. The next mistake is placing it right below the swing low without a buffer. The market dips, forms a wick, hits our stop loss, and then moves up. On a chart, imagine a support or resistance zone. The market takes a support, breaks down, and forms a green candle where we decide to enter a buy. As a typical trader, we place the stop loss right below the swing low. What happens? The market makes a quick move, forms a wick, hits our stop loss, and goes up. What should we do? Set a stop loss with a good buffer. With enough gap, our stop loss avoids getting hit, and we hit our targets. We need to set logical stop losses to survive quick stop loss hunting moves. The fourth mistake is trading without risk management. Many traders look at a chart, take a sell-side trade on a pullback, hit a stop loss, and the market moves up. We take another trade, hit another stop loss, then another, and it repeats. What's happening? We're trading without a plan. Sometimes we set a huge stop loss, sometimes a tiny one, or act randomly. This is trading without risk management. The fifth mistake to avoid is emotional trading, which has 2 parts: revenge trading and FOMO, fear of missing out. First, we must avoid both. In revenge trading, suppose we hit a stop loss and take a loss. Our plan says to close the day, but we take another trade to recover it. That hits a stop loss too, increasing pressure. So we take another, and it spirals. Our psychology is off. leading to consistent losses. With FOMO, we enter a trade, exit with a profit, but the market moves higher after a pullback. We think, we made a profit, but holding longer would have earned more. So, we re-enter, only for the pullback to hit our stop loss, cutting our profits. This can lead back to revenge trading, creating a cycle we must avoid. Most traders fall into this trap. The sixth mistake is not keeping a trading journal. A billion-dollar company tracks profits, losses, and performance through weekly or monthly audits. In trading, where we dream of big profits, why aren't we tracking our trades? Treat trading as a business. We must note daily trades and review them periodically. This helps us identify and fix these mistakes independently. Start maintaining a journal now. We hope you learned something valuable from this video, then subscribe to the channel and like the video. See you in the next one. Until then, bye.